Hello and welcome back to the Fixed Income Securities series of NISM. So let's continue with the next chapter, that is chapter 3.1.2, Risk Call Risk. So call risk is the risk of a bond being prematurely called or repaid by the issuer exercising the call option provided in the indenture of the issuance. This typically happens when a corporate decides to refinance its liabilities with a lower cost of borrowing. The call risk makes the bond unattractive to the investor vis-a-vis a non-embedded option bond as it increases uncertainty for the investor. The issuer has to pay a risk premium known as the call premium for the comfort or right of repaying the debt when the market replacement cost falls. In order to compensate for the call risk, the investor would receive a higher return on the callable bond vis-a-vis a non-callable one. Estimation of call premia can be explained with the simple example of a bond with 10 years of maturity that has a call option at 5 years with 8% coupon with present interest rate yield at 8%, and the bond without any option is trading at par. The chance of this interest rate moving upward and downward may have different probabilities as given in the table below. Table 3.1. So coupon, here we have the coupon that is 8% only. Here we have the yield that is going from 4 to 11%. Then the probability of call is from 90 to 30%. And the one probability is going from 10% to 70%. Since there are various scenarios, we have to calculate the average price of the bond, taking all possible scenarios and compare it with the average price of a call-free bond with similar maturity and ratings. The difference is the expected call premium the issuer has to pay if it wants to if it wants a right to call the bond during the life of this bond before the call date, subject to our assumption of interest rate scenarios probabilities. When the probabilities of interest movement change, the premium will also change. The next chapter is chapter 3.1.3, that is reinvestment risk. So reinvestment risk arises when the periodic income received from bonds or other fixed income securities are reinvested after their receipt at the rates prevailing in the market at the time of such receipts. If interest rate is higher at the time of receipt of periodic coupon, the reinvestment would happen at higher rate. That is beneficial to the investor. But if the market interest rate is low at the time of receipt of the coupons, the investor would be reinvesting the coupons at lower rates. However, it may be remembered that higher interest rate vis-a-vis the coupon would mean capital loss in the market value of the bond if the investor wants to sell it in the market. Therefore, reinvestment risk is the risk that interest rates may decrease during the life of the bond. If an investor wants to hold the security till maturity, then reinvestment risk may become high. Risk is an important part of bond investments. Next chapter is chapter 3.1.4, that is credit risk. We will cover this topic in the next video. So that's it for now. Thank you.